we had basically a spike pullback channel on Friday, and the bull channel was a bear flag. I say that because 75% of the time you'll eventually get a break below the bull trend line, and then a conversion into a trading range. And you can see we're obviously breaking below the bottom of the channel. Bears are hoping that we continue the sell-off that we've had for 6 months. Let me just snap that to the open of the week. Today's open is the open of the week and the open of the day. Last week's low is just a little bit below where we are. Daily chart, you can see this little dash there for yesterday. Yesterday's a holiday, and they will remove yesterday by the end of today. Let me reload this. It's possible that they've already removed it. We'll see. No, it's still there. You can't really see it on this chart. But if I do it this way, you can see there's a little bear inside bar there. That's from yesterday. It's a holiday, and TradeStation will remove that by the end of today. And that means on Friday is a low one sell signal. The bears want to get below Friday's low because they're hoping this is a resumption of the bear trend. This is a pullback, bear flag, and they want to trigger a sell by going below Friday's low. Friday is a good-sized bull bar closing near its high, and Thursday is a bull bar as well. And that makes this a relatively weak low one. We had a bull bar here for a low one. We went down a day or so. We had a bull bar here for a low one, and there were buyers below. The bears were hoping that the bear trend is resuming. On the daily chart, we had a bear trend starting at the beginning of the year, and we've been going down. We had a double top bear flag there. Neckline, we're around the measurement now. We might get a third leg down, 1 pullback, 2 pullback, 3. We had an attempt at a wedge bottom here, 1, 2, 3, and a pretty good reversal up. It failed. And very often, if you have a wedge bottom that fails and you get a couple legs down, you'll get a third leg down, and you'll have a second wedge. And if we do get that, if we do get a new low and a reversal up, that would be a reasonably high probability bet that we would go up for 20 or more bars. In other words, a month or two, maybe back up here, possibly all the way here. I've been saying all year, since the end of last year, that I thought the market looked like it was forming a wedge on the daily chart, 1, 2, 3, and it was way overbought on the daily, monthly, and weekly charts. And I thought we'd sell off at some time in the first half of the year. I did not think it was going to be for 7 months, but I thought we'd sell off in the first half of the year and then try to rally back in the second half of the year. And I still think that we're going to do that. However, we're so far below the high, I don't think we'll get back to the high. Now, the bearish channel could keep going down. On the weekly chart, we have not yet reached the pre-pandemic high, and a lot of stocks have fallen below the pre-pandemic high. For example, JP Morgan, the most important bank, it's below the pre-pandemic high. A lot of other stocks are all the way down to the pandemic low. And then there is a group of stocks that have not pulled back to this high yet. And the index itself has not pulled back to that high yet. There's the high before the pandemic, the pre-pandemic high, and this is where we are. This is around 3,300. I still think there's about a 30% chance we'll get there. Obviously, if we get a couple more big bars, this is the weekly chart, if we get a couple more big bear bars, instead of 30%, it becomes 40, 50, 60% as we get closer to it. Monthly chart, really strong bull trend, and therefore, as strong as this reversal has been, we're down 20%. As strong as it has been, it's still probably a minor reversal. So it's unlikely that we're going to get all the way down here to the biclimax low without a test back up here. So that's another reason why I think that we don't have a lot more to go, and then we'll test back up here. And then once we're there, the bears might be able to get a double top and a major reversal. But right now, this is still probably a minor reversal. There's a micro wedge on the monthly chart, 1 pullback, 2 pullback, 3, and on the daily chart, there's an actual wedge 1, 2, and 3. Expect a couple legs down, 1 pullback 2, which is also a wedge here, and expect a couple legs up, 1 pullback 2, and it failed. Even though we had very strong rallies here, here, and here, it failed. So you got to be looking for a measurement down from this double top neckline, and we're right around there now. This is strong enough down so that it might get a third leg down, so 1 pullback 2, pullback 3. This is strong enough down so that we may get a second leg down, so 1 pullback 2. So I do not think that this is the final low. But if we do go below this low and get a reasonable reversal up, then I think we'll rally for at least a couple months, maybe for the remainder of the year. 5-minute chart, we have a big bear bar closing near its low. I got to put a line in for I don't have a line for Friday's low. In general, if we have a big gap down and a big bear bar, I want to see a second bear bar before I'm willing to sell the market, sell closes. If I'm selling far below the average price, the moving average is one measure of what is average. If I'm selling far below the average price, I want bars to look far more bearish than average. So I'd like at least a couple consecutive bear bars. Preferably 2 big bear bars. We have a big bear bar here. I'd like to see a second big bear bar here. And I suspect we're not going to get it. Remember on the weekly chart, last week is a low on sell signal bar. And the bears are trying to get below it. On the daily chart, Friday is a low one sell signal bar. We're trying to get below Friday's low here to trigger the daily low one sell signal. And we're trying to get below this blue line, which is last week's low, to trigger the weekly low one sell signal. Weekly chart, we have a trend. We bounced for a couple weeks, and here we bounced for a few weeks, resumed down. Here we bounced for a couple weeks, resumed down, bounced, resumed down, bounced, resumed down, bounced. Traders expect the pattern to continue, and patterns tend to continue. So I think we're going to go below last week's low and trigger the sell. And I think we're going to go below this low as well before we go up here. But I do not think we're going to reach the pre-pandemic high. So I think we'll get a bottom above that high and below this low. But every new bar gives additional information, and that changes the probabilities. Bears trying to break below yesterday's low, Friday's low. When I say yesterday, I mean the bar to the left of this line. I don't want to be wondering, is it the Friday, is it Monday? So if I just scroll back here manually, if I just scroll back looking for some kind of a pattern, I call this today and that yesterday. And I don't know if this is a Monday and this is a Friday. To me, to the right of the line is today, to the left of the line is yesterday. Bears obviously selling, bulls obviously selling. And a lot of times you'll get a big gap down in consecutive bear bars, and you'll think, wow, we're at support. Friday's low, last week's low. Do I really want to sell the close down here? Mathematically, it's reasonable to do it. You sell the market or sell the close or sell one tick below the low of the bar. The problem is you have a stop above here. So you're risking 30 points, $1,500 per E-mini contract, and that's too big. And what I recommend doing in a situation like that, where you have a reasonable trade, but the stop is too big, the risk is too big, you have to reduce the risk. The easiest way is to reduce the position size. And I think it's too complicated to have 5 different position sizes. If the bars are 20 points tall, you use maybe a 20% position. If the bars are 10 points tall, you use a 50% position. I think it's better to have 2 position sizes. Your normal size, and if the bars look big and you're afraid to take the trade, then you have to have a second size. And I recommend for the second size, having it be much smaller, like a 20% size. So if you normally trade on 1 E-mini, 20% of 1 E-mini is 2 micro E-minis. So right now the risk here is very big, almost 30 points. And that's too big for most traders, so you have to trade smaller. And I wouldn't spend a lot of time thinking about the position size. If you're going to take a trade, you trade 20% of normal so that your risk is really small. And if it keeps going your way, you can sell more as it goes down. And if it reverses, you can get out above a bull bar. My general rule is get out above a bull bar closing above its midpoint. When the bars are big like this, I would get out even above a bear, like 5 points above the bear bar. So instead of getting out above 1, I would get out either 5 points above 2, or if 3 has a bull body closing above its midpoint, I'd get out above 3. Now, you can also get long. This could be a failed breakout below yesterday's low. Remember yesterday we had a bull channel, and it's a bull trend, and bull trends usually do not immediately become bear trends. They typically have to convert into a trading range before they can become a bear trend. And therefore, this is probably going to have to form some kind of a trading range open. Not necessarily on the first bar, but we're probably in the first hour, we'll have at least 2 reversals. And once we've had 2 reversals, I call it a trading range open. We have not had 1 reversal yet. It has to be after the first bar. Like look at yesterday. We went down and we reversed up above 2, and then we reversed down below 6. So at that point, I think it's a trading range open. On Friday, it was a triangle, trading range for half the day. Middle of the day, the market often tries to change what it was doing for the first half of the day. If the first half of the day is a bear trend, the market tries to get a reversal into a bull trend in the middle of the day. If it's a bull trend, you'll often get a reversal down in the middle of the day. And if the day is a trading range, you often get a breakout into a trend at the middle of the day. If the first half of the day is a trend, you often stop doing that and convert into a trading range. Bulls, can you buy above 3? I think if it's a huge bull bar comparable in size to 1 or 2, you could buy above it. It's probably not going to be that way. We're 2.5 minutes into the bar, and it's a small bar. So reasonable to get out of shorts above a bull bar closing above its midpoint. Possible sell climax and low of the day. Higher probability, wait for a second consecutive bull bar. And here we have 2 bull bars, but big tails. It's better to have bull bars closing near their highs like this and that and that. And the more bull bars you get closing near the highs, the more likely the market's going to go higher. Globex chart, we went below the Globex low. We had a strong rally on the Globex open, trading range, and then we've been selling off since. We just went below yesterday's low, and we triggered a low 1 sell signal on the daily chart. But it looks like there were as many buyers as sellers. So that's not what the bears want to see. They want to see it go below yesterday's low, and they want the bulls to give up and the bears to sell aggressively. And instead, the opposite is happening. The bears are taking profits, and bulls are buying. Bears will try to get 3 to be a bear bar, even a 1-tick bear body. Any kind of a bear bar will increase the chances that we're going below last week's low. Right now, I think we're going below last week's low. We have a big gap down. We have 2 big bear bars. Last week's low would trigger a low 1 sell signal on the weekly chart, and we're in a bear trend. So all of those factors, I think, are enough for traders to expect it to go below last week's low. It might bounce first, but I think at some point today, we're going below last week's low. And this is strong enough down so that we're probably going to do it in the next few bars, probably in the first hour. Everybody's waiting to see what the bar will look like. Will it close with a bear body? Will it close on its low? That would increase the chances that we're going down to the next magnet. Okay? You see in the final second, it became a small bull body. You can't see on this computer, but it's a 1-tick bull body. So the bulls were unable to get the reversal, and the bulls who bought hoping that 3 would be a big bull bar. A lot of them are exiting. Now, you also have sell to close bears too. Bears were sold to close or sold below 2. And they're disappointed that 1 is a bull doji instead of another big bear bar. If enough bears are disappointed, what are they going to do? They're going to place a limit order to get out right around where they shorted. So if they sold around the 2 close and they're very disappointed by 3, they'll try to get out on the 2 close. And it looks like a lot of traders are doing that. A lot of the bears who sold on the close of 2, disappointed at 3, are buying back the shorts. They don't want to be short this far below the average price unless everything is very bearish. 3 is not very bearish. So a lot of the bears are buying back shorts. The bulls know the bears might do that. So once everybody sees 3, you have bears placing limit orders to buy back shorts around the close of 2. And you have bulls placing limit orders to buy around the close of 2 as well, taking a chance the bears will give up. And the bulls can use a pretty tight stop, because if the bears are going to give up, they're not going to give up 5 or 10 points below 2. They're going to give up around the close of 2, maybe 2 or 3 points below. So the bulls who buy with a limit order here have a stop not far down, and they've already made more than what they were risking. And they're hoping this continues up strongly and that this is the low of the day. 3, it's only a bull doji and it's following 2 big bear bars, not a strong buy. And therefore, a lot of the bulls will scalp out. They get their 10 points and they sell. And they have their 10 points right here. Also, the bears look at 3 and say, that's a bad buy. 3 is just a doji. After 2 big bear bars, that's not many people are going to buy above 3. So the bears will either sell the 3 high and scale in higher, 5, 10 points higher, or they'll place limit orders to sell 5 or 10 points above the 3 high. And if you notice, the 3 high is exactly 21 ticks above, the 4 high is 21 ticks above the 3 high. Why is that important? If you sell 5 points above the 3 high, it has to go up 21 ticks for you to get filled at 20 ticks. We're going up 21 ticks in the market on the reverse down. That tells you that there were a lot of bears with limit orders selling 5 points above 3. Yeah, it has to fall below the 3 high for them to scalp out 5 points, which it just did. And the bears buy back in shorts. And what happens? The market goes back up. Trading range open is still most likely. Bullish chart really oversold. Parabolic wedge, different ways to look at it. 1, 2, or 3, or 1, pull back 2 or 3, or 1, 2, 3. In any case, it's a series of many big bear bars here and here and here. So it's consecutive sell climaxes. And that typically will result in at least a couple legs sideways to up. A big bear trend like this usually will not reverse straight up in a V bottom into a bull trend. Typically, you'll have to go sideways for 10 or 20 bars and get some kind of a double bottom. But this is so extreme that there's I think, better than a 50-50 chance we're going to try to get back up here, another 20 or 30 points above where we are. So magnet below, last week's low, magnet above, the high of the day, the top of the most recent sell climax, and then the moving average. Moving average is a 20-bar exponential moving average. It's based on 20 bars. Every time we add a new bar here, we take one of these high-priced bars out of the average and replace it with a low-priced bar. And it makes the average fall sharply, even just going sideways, because just going sideways, every new bar replaces one of these. So the average is based upon fewer of these bars and more of these bars. And typically by 15 bars, if we go sideways for 15 bars, the average will be based mostly on these bars, and it will be below the high of the day. What do you do here? Well, you can see the bulls scalped. They bought the close of 2. What about the stop order bulls who bought about 3? Well, they ended up making 5 points. It had to go up 22 ticks above 3 to be able to scalp out 5 points, and it did, and went more than that. So the stop order bulls made money, buying above 3. The limit order bulls who bought around the 2 close during bar 4 made money, and the limit order bears made money selling above 3. So bulls and bears are both making money with stop orders and limit orders. Does that happen commonly in strong bear trends or strong bull trends? No, it more commonly happens in trading ranges. So what's going on here is consistent with an early trading range. The top of the range might be around the 1 high and the moving average. Bottom of the range right now is here, but it might end up being a little bit below last week's low. The market went down on 2, up on 3, down on 3, up on 4. So market over bottom. And the neckline is the 4 high. But it's a big tail, and it's after a doji bar, so not a good buy above 4. It's a high 2 bottom, a second reversal up, and it's a second reversal up from below yesterday's low, Friday's low. But it's a bear bar, so not a good stop entry buy above 5. Not a good stop entry buy above 4. For the bears, we have a new low of 4, a pullback 5. It's a low 1 on the 5-minute chart. Low 1 sell signal bar. So it's a 5-bar tight trading range. We're always in short. We sell the close. We have last week's low magnet below. But you're selling far below the average price. And is this far above average bearishness? No, it's not. We're sideways for 4 or 5 bars. That will reduce the number of bears willing to sell below 5 or below 4. When you have an always in short market and you get out, let's say you get out 5 points above 3, if you're trading always in, you always want to be in the market. You have to get short again. You can sell below a bear bar closing below its midpoint 5, or you can sell at a new low 4. But neither one, I think, is particularly good because we're at yesterday's low support. We're at the Globex low support, and we're probably not going to go much below last week's low. So if you sell here below 5, you have to be pretty quick to make up your mind about what to do next. For example, if 6 reverses up and is a reasonable bull bar, it would be a second reversal up from below yesterday's low. And if it's a pretty good bull bar, traders will buy. They hope it'll become a big bull trend. But what did I say is most likely? Most likely a trading range open. I say that because most days have a trading range open, especially days with big gaps. And we have trading range behavior already today. We have 4 sideways bars, 5 sideways bars, and limit order bears and bulls both have made money. So that's consistent with the trading range open. We also went below the Globex low, so that takes care of one magnet. The next obvious magnet is here, last week's low. So if you're a bear and you're sold below 5, what are you thinking right now? You're thinking, oh, this is not doing what I want it to do. So a lot of bears will get out above 5 or above 6, no matter what the bar looks like. And they'll be especially eager to get out if 6 has a bull body. And bulls, the more bullish 6 is, the more bulls will buy above 6, hoping that this is the low of the day. The bulls would like 6 to look like 15 yesterday. And the more it does, the more bulls will buy. Remember, bears do not want to sell far below the average price unless the bars are far above average bearishness, like 1 and 2. But then we get 3 and 4, and those are not bearish at all. Bears, I'd get out 1 tick above a bull bar closing above its midpoint. I'd get out 5 points above a bear bar. So I would be prepared to get out above 5. And the bulls, some bulls will buy above 5 simply because it's a high two bottom, the second reversal up from below yesterday's low. So they'll ignore bull bar, bear bar, they'll simply buy the second reversal up. I think if you're looking for a reversal, it's better to buy above as good a bull bar as you can get. So, is it going to be a big bull bar closing near its high? If so, more bears will get out, more bulls will buy. Is it going to have only a small bull body or even a bear body? You'll still have some bears exiting, but a lot of the bulls will want to wait for a bull bar closing near its high. This is the 7 o'clock bar. Is often a news announcement or a news report or a financial report at 7 o'clock. So the market has an increased chance of a big move on 7, and it has an increased chance of the close of 6 changing suddenly in the final few seconds. Bear doji, so still on the sell below 5. I would get out 5 points above 6, or obviously you could get out above 4. Why is anybody selling here? Well, the bulls who bought during 6, hoping that 6 would be a good buy signal bar, they're disappointed, so you got bulls exiting, and the bears know the bulls are disappointed, so you got bears selling. So as soon as 6 closed with a bear body, you had traders selling the market, and they might scalp out part at 5 points or 10 points, or at last week's low. But with all of these reversals, they're ready to get out pretty quickly. Second reversal up from yesterday's low, and not many buyers above 6. Not many bears bought back shorts, not many bulls went long. And the reason for that is we're in a tight trading range, sideways now for 6 bars. And in a tight trading range, traders tend to enter with limit orders. They sell at the high of the prior bar and higher. They buy at the low of the prior bar and lower. So they bought below 5, they bought below 6, they sold above 6, they sold above 3, they bought below 3. Trading range open. What happens if 7 closes on its high? Possible low of the day. We're still on the high 2 buy above 6. Even though 6 is not a good buy signal bar, if 7 closes on its high, you'll start to get more bulls willing to buy. It's a 15-point tall bar. So that's, if you're trading the mini, it's $750 risk per contract. Reasonable to trade small. Remember, trade small means 20% of your normal size. So if you normally trade 5 micro E-minis, you would trade 1 micro E-mini. If it keeps going up and you get other buy signals, you buy more. If it goes down, you just get stopped out, and you end up not losing very much. Bear trend always in short, but not a lot of bears selling below things. Selling below 2, selling below 3, selling below 4. They are selling above things, the 3 high, the 6 high. And they're selling bullish things, the close of 4, betting against a successful reversal. Might end up with a parabolic wedge, down on 2, up on 3, down on 6, up on 6, down on 7, maybe up on 8 or 9. Traders want to see what's below last week's low. It's a low one sell signal bar on the weekly chart, and the weekly chart is in a bear trend. Well, technically, the daily chart has a series of lower lows and lower highs. We have a slightly higher high here, slightly higher high here, but basically a series of lower lows, lower highs. That is a bear trend. Weekly chart, we have a new low, and we have a lower high here, even though it's above that high. We have another lower high. We have another lower low. So weekly chart is in a bear trend. Monthly chart, we have a lower high and a lower low, but that's not a series yet. So monthly chart is not in a bear trend. It's in a pullback. We're in a bear market. We're down 20% from the high. A bear market simply means down 20% from the high. I want to say one other thing about that. That's what you always hear on television, but that's not exactly correct. I think most of the institutions have a second part to that, and it's this: down 20% from the high for 2 or more months. So a lot of the institutions will say, yeah, daily chart, weekly chart, it's a bear trend, and it's down 20% from the high. So they'll say it's in bear market territory, but they will not say bear market until we've been down 20% for a couple months. Might bounce down 15%, down 25%, but they want it to be down around 20% for 2 or more months before they say bear market. So you can argue that we've only met part of the criteria for a bear market, and that therefore even the daily chart might not be in a bear market. Bear trend, yes. Weekly chart, bear trend, yes. But bear market, I think there's not as broad a consensus. I reverse up above 3, above 6, and now above 8. And if 8's the bull bar, it would be a third reversal up. Does not look like a wedge, but it's a wedge. If you look at the smaller time frame chart, there's probably a wedge here. You can put up a 1-minute chart and see if you can see a wedge. Okay. Different ways to look at it. 1, 2, and 3. That's one way to look at it. So 1, pull back 2, pull back 3. So on a 5-minute chart, it's 3 legs down. 1, pull back 2, pause, and then 3. But the bulls do not want to buy with stops in a bear trend unless they get a really strong buy signal bar, or unless they get 2 or 3 consecutive decent bull bars. So don't be too eager to buy with a stop above 3, above 6, above 8. If 8 closes near its high, it's a parabolic wedge and a sell climax. Plus, the location is really good. We're almost below last week's low. So it would be a reasonable swing buy above 8 if it closes near its high. Right now, it's more likely we're going below last week's low. But sometimes the market will get right down to a really important support level and then reverse up into a bull trend. Last week's low is a really important level. So do not be surprised if we reverse up from just above last week's low. I have a section on almost outside down bars, but it's the same thing. Anytime the market gets near some major support, even if the sell-off is really, really strong, sometimes it will reverse up and not go below that support. We went above yesterday's high, tried to get below yesterday's low, we sold off strongly, and they bought above yesterday's low. Bought above yesterday's low. Bought above yesterday's low. And it doesn't matter, it could be yesterday, it could be last week's low. Any kind of major support. I don't know if I have an example of last week. Again, right above, here we sold off for 6 hours and they bought right above yesterday's low. And it's true on any time frame. Open of the month, we went just below the open of the week and just above the open of the month and reverse up. Time frame. Open of the month, we went just below the open of the week and just above the open of the month and reverse up. So I'm just making the point. Okay, so that's a credible buy. Possible low of the day, parabolic wedge. I bought that. Now, we're still in a tight trading range. And the bulls are hoping this is the low of the day. So they're hoping that we rally strongly from here and that we just go up for the remainder of the day. I said trading range open. I said a trading range open to me is after the first bar, you get 2 reversals. After the first bar, we reversed up above 3 and then below 5. So officially, on on bar 6, I would call it a trading range open, even though I said it was a trading range open right from the open. Now, some of the bulls, they're buying in a bear trend, and they're afraid it could be a minor reversal, a leg in a trading range open. So they will scalp out. I would not scalp out 5 points unless it starts to stall. Then you convert to trying to scalp out 5 points. But the bulls might try to take part off of 10 points, expecting a trading range open. We have a wedge bottom. We'll probably get a couple legs sideways to up. 60-minute chart. The bulls are hoping that all of this sell-off is simply a 50% pullback from this rally. Bears are hoping this sell-off is so strong that it will be a resumption of this bear trend. Bulls trying to end the selling and resume the buying for a higher or low major trend reversal. But they want a good bull bar. They had one here. It failed to reverse up very much. And here, bull bar closing in its high, failed to reverse up very much. And in the next 15 minutes, the bulls will try to turn this 60-minute bar into a big bull bar closing near its high. The more they're able to do that, the more traders will think that the bull trend that we had over here is resumed. This is the daily chart. So we have a higher low. By the way, in a lot of charts, and it's pretty interesting. We have a higher low here, but on a lot of other markets, we have a lower low. Snap, no, not snap. Let me try square. I think square is a lower low. No, not lower low. PayPal. Yeah, PayPal, a slightly lower low. And check NVIDIA. A lower low. So on some stocks, we have a lower low, and other stocks, on JP Morgan, a lower low. But other stocks, we have a higher low. Microsoft, higher low. So there's a divergence, which is bad for the bears. The bears want everything to be going down, and the bulls are happy to have some things not going down. So are we always in long? Well, we have consecutive bull bars, at least one big and closing near its high, and reasonable to take off at least half your position here at 10 points, because it still could be a minor reversal. Bulls are hoping it's the low of the day. That's a very good looking pair of bull bars, and we're at an important support zone. 9, a multiple of 3, so it corresponds to a 15-minute bar. Here's the 15-minute chart, and that's what we have. Basically a double bottom here, higher low double bottom here, a lower low double bottom here, but it's some kind of a double bottom, and it's a pretty good bull bar. But the bulls need to trigger the buy. They need to get above the high of that bar. So double bottom, neckline. The bulls want to break above the neckline and go up for a measured move back up here, which is last week's high. And the bears are hoping this is a double top bear flag. We went below the neckline. They're hoping this is a pullback from the break below the neckline, and they want it to go down for a measured move based upon the height of the double top. So we have a double top and a double bottom breakout move. Back to the 5-minute chart. Bears, do they sell below 10, double top 4? Some bears will take the short. We have a wedge, 3 legs down, 2, 6, 8. We're probably going to get at least a couple legs sideways to up. And if we're going to get 2 legs up, does it make sense to sell after 1 leg up? Probably not. It's a credible swing sell, a double top, but 2 very good bull bars, and fairly far below the moving average. So, yeah, it's okay for bulls to exit, sell out of longs below a bear bar closing below its midpoint. But for the bears, I would not take the short. We should get a couple legs sideways to up, and we're far below the moving average. Both of those things reduce the chances that we're going to go straight down below 10. Can you take the short? You're risking 10 points and you're trying to make 40 points. You can. Some bears will do it, but I'm not going to do it. Why is it selling up here? Well, you have some bears selling anything bullish, the close of 9, and you have bulls who did not scalp out part or all at 10 points, and they're seeing it go back down, and they're giving back all of their profit. So you get bulls panicking out of longs, thinking, oh, darn, I should have scalped off part at 10 points. What do you do with 10 bulls? I get out below bear bar, closing below its midpoint. And in bears, for me, I think the odds are we're going to get a couple legs sideways to up, so I'm not willing to short below 10. There's bought above 8, and now we're back to that 8 high. Are bulls going to buy again at that 8 high, or are bears going to overwhelm the bulls and resume the bear trend? Remember, I said trading range open. 10 is disappointing for the bulls. Still might be a trading range open. Bulls reasonable to get out below a bear bar closing below its midpoint, 10. For the bears, double top bear flag, but we're probably going to get a second leg sideways to up. So I am not willing to short below 10. I said second leg sideways to up because sometimes it's sideways, not up. Yesterday, 52, strong enough bull surprise. We're probably going to get a second leg sideways to up. And 54 was the second leg sideways. And that met the minimum objective. Bulls want a high one by 11, but 10 is the problem. Big bear bar closing below its midpoint, and bulls are afraid it could be a trading range, and they don't want to be buying too high in a trading range. Okay, fine. It's okay to be long. We're still long above 8. Theoretically, it's okay to buy above a bull bar, either 11 or 9, but it's still probably a minor reversal. So anybody buying, you have to make quick decisions. It's like selling below 3 or below 5. Market's deciding on the 60-minute bar. We have 8 minutes left. Is it going to be a good-looking buy signal bar? Is it going to be a big bull bar closing on its high? Or is it going to be a bear bar? We've been selling off for several days. The bulls need a very good bull bar closing on its high. Or is it going to be a bear bar? We've been selling off for several days. The bulls need a very good bull bar. If they do not get it, fewer bulls will be willing to buy above the high of the hour. I'm going to put a line up there. Whenever you look at the chart and you think, gosh, I really need more information. I'm not sure. It might go down, it might go up. That's confusion, and that's telling you that we're probably still in a trading range. And in a trading range, a lot of traders want to buy low, like about 8, but scalp. And they want to sell high, like the close of 9, and scalp. The bears have sold the close of 9. That filled around a tick or so below the close of 9, and they were able to scalp out for 10 points at 10. And that's part of the reason why we bounced at that 10 low. We had bears scalping for 10 points. To buy above 11, the bulls want as good a bull bar as possible. So far, 10 is an inside bar, and 11 is a second consecutive inside bar, so it's an II. Breakout mode. Theoretically, bears will sell below. Betting will break below the neckline 8 and go below last week's low. Bulls will buy above, betting that we've seen the low of the day, and that we're going to go back up to the 60-minute moving average. Today could end up being an inside day. Actually, an inside week. This week. Can today be an outside up day? Can we get above yesterday's high? I think that's too far up. That's 75 points above where we are. And that's probably too far, so it's probably not going to go above yesterday's high. Stop order traders, the bulls want 11 to close near its high. The bears want 11 to close near its low. Remember I said a second leg sideways to up. Well, 11 is a second leg sideways. Up on 9, down on 10, and then up a little bit on 11. So it has fulfilled the minimum objective of the bulls buying the wedge bottom. So basically sideways here. Not going to attract a lot of sellers below 11. Not going to attract a lot of buyers above 11. This is bar 12, the final bar of the first hour. It affects how the first hour will look. When the trading range open, limit order market. Traders buying low, selling high, taking quick profits. A trading range is breakout mode. This is a tight trading range. That's breakout mode. II, breakout mode. Breakout mode means 50% chance there'll be a successful bull breakout, 50% chance successful bear breakout, and 50% chance the first breakout up or down will fail. Bull 1 with a bull bar and a limit order market. You can see they bought the 11 low. More traders bought it than sold it. If this is the start of a bull trend, most of the time, when you begin a trend on the open, the market will do something that makes you think that the trend is failing. And we have a very good reversal, 8-9. 10 is disappointing. We just triggered a low one, 11. So it's an attempt to make the trend fail. Well, it still could be the start of a bull trend. Limit order market. So bulls who bought the 11 low will scalp out near the top, maybe above 11, and bears might sell above 11. Now it's a small triangle. You have a couple lower highs and a higher low. On a smaller time frame chart, it'll be a triangle. Let me go a 1 minute chart and see. So we got lower highs, we have higher low. A triangle is breakout mode. So we're in a trading range. We're in a tight trading range. We have an II, all breakout mode patterns. Are we always in long, 8-9? For some traders, yeah. I'd like to see the market get above the moving average or have better follow through. This is the end of the first hour. And the first 60-minute bar is going to be a big bear bar, but it'll have a big tail below. We went below 11. We went above 11. We went back below 11. So limit order traders, lots of reversals. When a bar is not going to close above its high, or at the high or the low, the next important price is the midpoint. And this is the middle of the hour. And we close the hour below the midpoint, so that's good for the bears. What do you do here? You can still be long. We have not gone below a bear bar closing below its midpoint. 10. We have not gone 5 points below any bar, 11. So you could still be long. And for the bears to have a double top 4 and 9, but a bad sell signal bar 11. So I would not sell yet. I would wait to see if 13 closes on or near its low. Still on the buy above 8. I would get out below 12. And bulls who did go flat are looking for a bull bar closing near its high. And the bears are looking for a bear bar closing near its low for a sell signal bar. Market has not decided whether this is the low of the day or if we're going below last week's low. Breakout mode, you should always assume that it's a 50% deal. You know, it'll look bullish for a bar, and then it'll look bearish for a bar. And do not get too excited until we get a strong breakout, or unless we get a good bear bar near the top or a good bull bar near the bottom, like 8. Otherwise, until there's a breakout, there's no breakout, and assume we'll reverse forever. You know, obviously we're not going to reverse forever, but until there's a breakout, assume that every reversal attempt or every breakout attempt is going to fail. Is it slightly more bullish than bearish? Well, I always go back to the most recent clear signal, and that's buying above 8. And the bears have not gone below a bear bar closing near its low, so we're still on the buy. In a short below 13, a triangle, 4, 9. It's a bear doji. I'd rather sell below a bear bar closing near its low. What about selling below 10, a bear bar closing below its midpoint? I'm not going to do it. I'll wait to see if 14 is a bear bar closing near its low. And for the bulls, do you get out below 13? I still think it's better to get out 5 points below a bar, below 13, or 1 tick below a bear bar closing near its low, 10. Good bar for the bulls, breakout bar. On a smaller time frame chart, it's a head and shoulders bottom, left shoulder, head, right shoulder. Whenever you have a wedge bottom, you expect 2 legs up, 1 pull back 2. The pullback from the first leg up is usually the right shoulder of the head and shoulders bottom. And the second or third leg down, the first or second leg down with the wedge is the left shoulder. Back above the Globex low, the open of the week, the open of the day. Trying to break above the moving average. The bulls are hoping this is going to be the start of a bull trend. Bears are hoping that traders will sell the moving average, the open of the day, and the one high for a double top. Bulls need follow through 15, so very good bull bar 14. Can it close above the moving average and near its high? And then can 15 be a second consecutive bull bar? Is this going to be a big bull trend day, or is it going to remain a trading range day? That's the minimum expectation of bulls and bears, a couple legs up from the small wedge bottom. And will there be more bears selling the close of 14 and the moving average and the open of the day, or more bulls buying? If the bulls get a second big bull bar, 15, this could be a very big bull trend day. But so far, that's not what we're getting. We're having sellers at resistance. Some of the sellers are traders looking for 10 points profit if they bought, for example, if they bought above 9, they got their 10 points. Other traders are selling at the moving average, bulls to scalp out, bears to sell at the average price. Other traders are selling at the open of the day, open of the week. Currently, always in long, but I would get out below a bear bar closing below its midpoint, maybe 15. And the bulls, they're looking to buy bullish things. If you're going to be buying high, which is what the bulls have to do at this point, they want the market to be strongly bullish. Like the bears 1 and 2, I said the bears needed it to be strongly bearish, and it was not. 3, 4, 5, 6, and then 8, none of that is very bearish. Bears did not sell. Whenever you have a bull trend that has good bull bars and bad follow through, usually the trend does not last all day. I talked about that last week. Over here, we had a very strong reversal up and lots of big bull bars, but we kept getting big bear bars and increased the chances that the trend would not last all day. and it went up quite a bit, but then we got a midday reversal, and we gave back a lot of what we made earlier in the day. And right now the trend looks like this: big bull bar, bear bar, bull bar, bear bar. It reduces the chances that this is going to be a big bull trend day. For the bears, it's a failed breakout double top, 4-9. Failed breakout open of the day, failed breakout moving average, possible high of the day. And it's a reversal down, but the bar is very big, so the stop is very big. So if you sell below 15, you're risking a lot. We're back in the trading range open. So yeah, bulls are panicking out of longs if they fail to take profits at 10 points and at the moving average. But I think you'll get fewer bears willing to sell below 15. So bulls reasonable to get out of longs below 15, and bears, it's a swing sell, but if you trade it, you have to trade very small. So you trade that 20% size. Can there still be a small pullback bull trend? Well, right now it is, but if we get a bear bar 16, then we're probably back to a bear trend. Back to the middle of a trading range open. We got a bear breakout 7, it failed. We have a bull breakout 14, it failed. Best choice here, flat. Second best choice, you sell, hoping that it'll become a bear trend. And third best choice, I would not buy. Bears, lower high double top 1, failed breakout double top 4-9. A bull trap 14, big bear bar closing near a slow, reversing down from the moving average, but in the middle of a trading range open. So if you trade it, I would trade small. You can always sell more lower. I did not take the short, so right now I'm back to flat. Magna below last week's low. The bear's trying to trigger the sell signal on the weekly chart, hoping that there'll be follow through selling all week. And bulls hoping that this is a small pullback bull trend. Small pullback 12, small pullback 16. Can you buy above 16? Well, you got a bear surprise 15. So odds are we're going to get a second leg sideways to down. So I'm not willing to buy above 16, even if it's a pretty good bull bar. And for the bears, the math is not very good. Now, why would some bears scalp below 15? Because they wanted 15 to collapse. And if it did not go down as fast as they want, they quickly will scalp out 5 points. And that's why we're getting this bounce here. The bears were disappointed that 15 did not fall faster, so they converted their swing trade to a scalp. Is there any reason to buy above 16? I would not. At this point, the odds are we're going to go lower. But that does not make it a good short. Bears, I'd get out 5 points above any bar. I'd get out 1 tick above a bull bar closing above its midpoint. You can see the bears have to be disappointed that 16 is not a big bear bar closing near its low. It's a bear doji. It's follow through after the big reversal down, but it's a weak entry bar. So it's on the short. I get out 5 points above 16, but it's not very bearish. We're in the middle of a trading range open. Everybody wants a trend. They're easier to trade. You have fewer decisions to make. And this is not a trend. The bears stride 2, the bulls stride 8, 9, 14. But it's still a trading range open at this point. So you have to trade it like that. Better take quick profits, look to buy low, sell high, and avoid avoid trading in the middle, which is where we are now. It's okay to be short at the market below 15 and get out 5 points above 16, but it's more likely we're going to go sideways more. Probably back to always in short, but traders are expecting reversals, so they're unwilling to sell too low and unwilling to buy too high. Why is it stalling here? Some of the bears are slow below 15, scalped 5 points. Others are scalping 10 points, so they have limit orders to buy about 10 ticks below 15. So they have limit orders to buy down here. So instead of the bears selling as it's going down, they're placing orders to buy back shorts. And that's why we're stopping to go down here. You got more bears looking to buy back shorts than you have bears looking to sell. The bulls, double bottom 12, lower low double bottom, micro double bottom 16, higher low major trend reversal. But what's the problem? We're in the middle of a trading range, and that will reduce the number of bulls buying about 18. If 18 is perfect, it's probably an okay buy if it closes on its high. But it's probably not going to be perfect. And for the bears, they're still on the sell below 15. They're hoping to make at least 10 points. They're hoping that this is going to be a bear trend. We have a double top 1, 14. They want to break below the neckline 8 and fall for a measure move down. But right now, reversals, limit order, trading, scalping. What do you do, 18? Well, the more it closes on its high, the more it looks like 8, the more bulls will buy. If it's not particularly big, a lot of the bulls will wait to see if we get 2 or 3 bull bars and then buy. Bears, I get out of shorts above a bull bar closing above its midpoint. I would not get long, even though it's a higher low major trend reversal. Double bottom 12. It's only a bull doji, so it's still on the short below 15. I'd get out of shorts, maybe a few points above 18, maybe a couple ticks above 16, but it's not good enough to buy. Even though back to always in short, at this point, I think it's too low to sell unless we get more bear bars. We should get below last week's low. I don't know how much below it we'll get, but at least 1 tick below it. Bulls will try to get a double bottom 8, and they'll try to prevent it from getting below last week's low. But we're probably back to always in short. 3 bear bars below the moving average and magnet below. Some of the bulls who bought above 8 are still long, stop below 8. I would not be. I would get out below 15 and look for another buy. And 19 is not good enough. And for the bears, it's not a strong sell-off. So they'd rather sell rallies. Can you sell on a stop below 8, the neckline, double top 1, 14? You can do it for a swing, but it looks more like a trading range open, a bear leg in a trading range open. So I think it's better to be selling high, somewhere in the upper half of the trading range, not at the low. And if we break strongly below 8 and get consecutive big bear bars, then maybe sell closes. Wait for it to convert into a strong trend before selling at the low. Micro wedge, down on 15, up on 16, down on 17, up on 18, down on 19, up on 20. Very often, you'll get a double bottom or a double top, and the second leg will be a wedge. Here we've got a lower low double bottom, second leg is a sell climax. So gap down, double bottom, sell climax, and then reversal up, but a good buy signal bar. Very often, the second leg down is some kind of a wedge like that, or like this, 1, 2, and 3. The bulls want a bull bar closing near its high. Double bottom with yesterday's low and a wedge. Higher low double bottom. And it doesn't look like a wedge, but it probably is. Down, pause, down, pause, down. This is probably a micro wedge with those tails, but it's a double bottom. Small double bottom. Double bottom, lower low double bottom, and some kind of a wedge. Better to buy above the bull bar closing near its high. Double bottom, the second leg is a wedge. Better to buy above a bull bar closing near its high. So will 20 close on its high? Probably not, but if it does, it's a credible buy. It looks like they're trying to get down below last week's low to see what's there. Are there buyers or sellers? Reasonable to exit shorts above a bull bar closing above its midpoint 20. While it's possible below the day, it's a 7-bar bear microchannel and only a doji bar, so probably sellers above 20. So I would not get long above 20. We're still probably going below last week's low, which means obviously we have to get below the 8 low. If it's not a good buy, 20, you just sell the market and then exit maybe 2 or 3 points above 20. You probably can. I think at this point it's better to be flat, but I think it's okay to get long. It's okay to be short, but I would get out maybe 2 or 3 points above 20. Chances are we're going below the blue line. The bears want us to go a lot below the blue line. They're hoping that we have a double top neckline and we fall for a measure move down. This is the top of a gap, 15-minute chart, 60-minute chart. We had, that's actually the bottom of the gap. We gapped up here, pulled back here, did not close the gap. But this is the bottom of the gap. The bears would like to close the gap. And bulls are hoping that 8 will be the low of the day. But this micro channel, since 14, reduced the number of traders buying above 20 or above 21. They'll wait to see if we get 2 consecutive bull bars. Still a bear micro channel, but not much selling. Big tail on all of these bars. So more bearish than bullish, but not strongly bearish. Reasonable to get out 2, 3, 4 points above any bar, 21, 20. But for the bulls, it's not good enough to buy. 14, really good bull bar, but a second leg up at resistance. And you can see a lot of traders sold it, sold the close, sold the moving average, sold the open of the day, open of the week. So 14 is a bull trap, trapping bulls into what they were hoping was going to be a big bull trend. On the open, 50% of strong moves in either direction are traps, and the market will reverse. Here, Friday, very strong move up, it reversed. Very strong move down, it reversed. Big sell-off, reverse. Big move up, reverse. Big move down, reverse. So always assume that no matter how strong a move is on the open, 50% of the time is simply a test of support or resistance, and it's a trap, and it's going to reverse. So don't be surprised that 2, we got a minor reversal up, and that 9, we got a reversal down. 14, we got a reversal down. Are a lot of bears going to buy back shorts here? Above 20, above 21? And will this be the start of a bull trend? Or will some bears exit and then a lot of bears sell above 21? It's probably more sellers above 21 than buyers. If 22 closes on its high, you'll get more bears buying back shorts and more bulls buying. But right now, there probably are more sellers above 21. 8-bar bear microchannel and important magnet just below. The bulls, higher low major trend reversal, higher low double bottom 8, bull bar 22, but tail 8-bar bear microchannel. Probably more sellers above 21 than buyers. The bulls do not have a good bottom on 21, and therefore they need a strong breakout. A strong breakout with follow through above the moving average. Otherwise, the bears will get the new low. The bears will low 122, put a bull bar at the bottom of a trading range open. So that's not going to attract a lot of sellers. So not a good stop entry buy, not a good stop entry sell. That means it's probably a good limit order sell above 21 and probably a good limit order buy below 22 or below 8 or below last week's low. Still always in short, still on the sell below 15, but not strongly bearish. At least not yet. And the bulls need a better bottom or a strong break above the moving average. Otherwise, traders are going to sell everything that looks bullish. They'll sell a reversal at 21. They'll sell a bull bar, close 22. The bears who get out above 21 theoretically would sell at a new low below 20. I think it's not worth it. This is a tight trading range at the bottom of the trading range open, and the bulls do not have a good reason to buy yet. Bears had to get out of shorts above 22, and for the bulls, they need a good buy signal bar. Can you call this a triangle? Well, you can. It's not a good shape. We have a lower high 23 and 2 higher lows, 20 and 23. Bulls need a good buy signal bar. Chances are we're going below last week's low. Chances are a lot of bulls do not want to buy until they see what's below last week's low. Will we collapse as we trigger the weekly sell signal, or will it be a trap? Can you buy above 24 if it closes on its high? It's a possible low of the day, higher low major trend reversal. 6 bars in a tight trading range, all with big tails, right below the moving average. So that's not a very high probability buy above 24. The close of the second hour, the bulls would like the hour to have a bull body, so they'd like it to close below the open of the hour. The hour opened bar 13. So the bulls would like bar 24 to close above that red line to create a bull body on the 60-minute chart. I don't think that really is important. The dominant feature on this chart today is trading range open. We had a good buy below 8, a good buy above 8, good sell below 15, and we're still in the trading range, so we're still breakout mode. We're currently on the sell below 15, but not many traders are selling. We're just going sideways. Tight trading range since 18. but the bulls really need a breakout above the moving average, and the bears need a strong breakout below the low of the day with follow through. Do I think we're going to collapse, or do I think we're going to go up? I think we're not going to collapse. I said a few weeks ago that on the daily chart, after this, we may just go sideways for several weeks. And so far, that's what we're doing. The bears are trying to get a resumption of the bear trend. But we still might be sideways. I said we could be sideways for a month. And it's still consistent with that. Obviously, we're still in a bear trend. And we do not have a clear, convincing bottom yet. But it's not very bearish right now when you just look at the past 15 bars or so. Bears, I'd get out above a bull bar, unless it's closing above its midpoint. And for the bulls, it's probably better not to buy above 24. And we can see a strong breakout above the moving average. If the bulls need a strong breakout above the moving average, can you sell above bars 24? Can you sell at the moving average like 14? I think it's reasonable to exit shorts 2 or 3 points above 24, a few ticks above 22. But I think the probability is just not very good yet for the bulls. Better to wait to see if we get a breakout and follow through and then buy. So wait for a couple of bull bars closing above the moving average, or wait for a better buy signal bar. Better to wait to see if we get a breakout and follow through and then buy. So wait for a couple of bull bars closing above the moving average, or wait for a better buy signal bar. No rush. If this is the start of a bull trend, the rally will last probably at least a couple hours and plenty of time to buy once it becomes clearly bullish. The bears are low 222 at the moving average, but 7 doji bars. So plus a bull body. So not a very good sell. Most traders better off flat. If you have to be in the market, if you want to be trading always in, I would be short. I'd get out above 25. But most traders should be just waiting. The bulls are hoping that the sell-off from 15 is a pullback from the rally that began with 8. But to convince traders of that, they need a strong breakout above the moving average and probably consecutive bull bars closing near their highs. Bulls trying to break above the moving average. Bears will sell the moving average like 14. They'll sell at close to 27 like 14. The bulls need to get a bar closing far above the moving average, and they need a follow through bar. They had a good bull bar 9, bad follow through 10. Good bull bar 14, bad follow through 15. And then bull bar 4, bad follow through. They need to change the appearance from trading range trading, where you expect reversals and bad follow through, into trend trading, where you get a series of consecutive bull bars. Now, is it going to be buy the close and will we continue higher, or is it going to be sell the close? I think it's a pretty good bull bar. I think it's okay to buy the market and take a chance, but if we get a bear bar closing near its low 28, I'd get out below the bear bar. The context is good. We're reversing up from a double bottom and a tight trading range, and it's a fairly big bull bar closing above the moving average, closing pretty far above the moving average. Bears need a bear bar. They're hoping that it's another bull trap like 14, but they need a bear bar. If we get a bear bar 28, the bears will only sell it if it closes near the low of the bar. Right now, I think more likely we're going to go higher. The bears have been trying repeatedly to get down below last week's low, and they're failing. And when that happens, the market then often tries the opposite direction. Is this the start of a big bull trend? Probably not. It's possible, but the more sideways bars that you get, the less likely you're going to get a big trend in either direction. Is the character of the day changing from a trading range into a bull trend? The more we get bull bars closing near their highs, the more likely it's going to be a bull trend. The bears know it's probably not going to be a big bear trend day, but they're hoping it's not going to be a big bull trend day. So they're hoping this is going to be a bull leg in a trading range, and that we'll get a bear leg in a trading range before long. To sell below 28, the bears need a bear bar closing near its low and preferably closing at or below the moving average. And the bulls would like a bull bar closing near its high. That would increase the chances that we're going up to the 60-minute moving average. But at a minimum, they'd like no bear body. And they certainly do not want a bear bar closing near its low. What happens if it's a bear bar that does not close near its low? Probably buyers follow. That does not close near its low? Probably buyers follow. We broke out above the tight trailing range, 25 high, so we may have to come down and test that high. Bears lower high in a bear channel, 14 is the lower high, 28 is the lower high, but bull body 28 probably always in long. We have consecutive bull bars closing above the moving average, and one with a body completely above the moving average. However, it did not close on its high. It would have been more bullish had 28 closed on its high. So we may have to test that 25 high. Bulls, I'd get out maybe 5 points below 28. And for the bears, I would need a bear bar closing near its low. Still on the buy, one tick above 25, still on the buy of the close of 25, and the stop order bulls have bought above 25. But I get out maybe 5 points below a bull bar 28. You sell below 29, a lower high, maybe a triangle. We would have two lower highs, we have a higher low. We've had a lot of triangles lately. I still would not take the short. I still think there probably will be buyers below 29 and buyers around the moving average and the 25 high. High one, always in long, but at the top of a trading range open. I would get out of longs 5 points below a bull bar. And for the bears, I would need at least a couple bear bars before shorting. I would not short below 30. If we go below 30, it's more likely it will be a pullback, a 50% pullback, a test of the moving average, a test of the 27 and 25 high. High one, but not a scalp. Bulls buying about 29 are hoping that we'll race up to the 60-minute moving average. They know we probably will not, so they'll be quick to get out if it does not race up. Near the top of a trading range open, so you got a lot of bulls not willing to buy at the top. They'll wait for a strong breakout above and buy, just like a lot of bulls waited for the breakout above 25 to buy. Otherwise, bulls will look to buy a pullback, maybe to the moving average and the 25 high. Bears are hoping it's a triangle. We have a big gap down, a bear trend, and now we have a high, a lower high. They want another lower high after a higher low. Triangles often have two legs up and down, so one pullback two, one pullback two. You know, this is not so clear. Maybe one pullback two, one pullback two. You can see not a lot of bulls willing to buy high after a small bull bar 28 and small bull bar 29. Possible triangle. Bulls, I'd get out below a bear bar closing below its midpoint. I'd get out maybe 3 points below a bull bar on 29, but chances are reversal down will be minor. By the closed bulls, 14, disappointed 15, never had a chance to get out break even. And therefore, some of them are still long, and they're hoping to get out break even. So there are, by the closed bulls, 14 with limit orders to exit at the 14 low, maybe a few ticks, maybe a point below. And that's part of what's going on here. You have bulls who bought 14, relieved that they can get out around break even, and they're selling to get out around break even. The bears know that, so the bears are selling as well. The bears are hoping it's a triangle and a bear trend, and they need a good sell signal bar. But 3 bull bars closing above their midpoints, closing above the moving average. I think it's better to wait for the market to stop going up, start to go sideways, and get some kind of a micro double top before selling, or wait for 2 bear bars and then sell. Because of all the trading range trading and the weak follow through 28, we may have to test back to the middle of the range, the moving average, the 25 high. Triangle, trading range open, okay to exit below 30, but I suspect there'll be buyers not far below. You don't have to get out below 30. You can get out maybe a couple points below the breakout point, the 25 high. You can see there are bulls buying the close of 30, trying to prevent 31 from going below 30. If 31 goes below 30, a lot of bulls will exit, and bulls do not want that to happen, so they're buying the close of 30. And for the bears, it's a triangle and a bear trend, but I think it's not a good enough sell. I would wait for it to go sideways for a few bars, maybe form a micro double top and then sell, or wait for another big reversal down like 15 and then sell. On the open, we sold off and tested last week's low, and then we tested it again. So we have a double bottom. The second leg down was a wedge. We did not get a good buy signal bar, 21, 26, but we got a good breakout, 27, with follow through. And we've been channeling up ever since. The channel has been tight, and that meant that reversal attempts were all likely to be minor. The bears had a decent sell signal bar, 51, nested wedge, 43, 46, inside of a bigger wedge, 14 and 36, but the bears only got a 5-point scalp, a minor reversal. The bulls had a bull inside bar, 53, and then a micro double bottom, 54, 52. The bears had an II 657, again at the 60-minute moving average. You could redraw the wedge and now call it 36.51, or you could just say that it's a failed breakout above the 51 wedge. But the bull bar in the tight channel, 6-bar bull micro channel, I'm not going to sell below 56. Outside up 58. And now we're accelerating up above the 60-minute moving average. I said earlier today that today could be an outside up day, but I did not think it was likely. And even though we've been rallying since bar 8, that's still 30 points above where we are. And so I still think today is not going to be an outside up day. I think we're not going to get above that. However, the bulls would like to get as far above the 60-minute moving average as possible. We have a double bottom on the 60-minute chart. The neckline is here. The bulls want to break strongly above it and then get back up here. And the bears have a double top. We broke below the neckline on the open today, and the bears were hoping this rally is just a pullback from the breakout below this neckline of this double top, and they hope that it will resume down. But 3 bull bars, 2 of them big, we're probably going up to this high, which is Friday's high. I don't know that we'll get there today, but we might get there tomorrow. Yesterday, Friday, bull channel, bear flag. We broke below the bull trend line. Today, bull channel, bear flag. The bears are hoping we break below the trend line. And the bulls are hoping instead that we accelerate up and form another breakout. So in a trend, you got to break out a channel and then a trading range. That's how I look at it. We have a breakout, a channel, and the bears hope we break below the bull trend line and form a trading range. But what sometimes happens, 25% of the time, you break above the bull channel and you start the process over. So breakout down here, channel, instead of trading range, we get another breakout and then we'll get another channel. This is becoming increasingly strong for the bulls. We might get up to Friday's close, Friday's high. I don't think we will, but we might. It's still a wedge, and we can still get a reversal, but the more bars we get in the tight bull channel, the less likely we'll get much of a reversal. Bulls, I'd get out below a bear bar closing near its low. You can always buy again above the next bull bar closing near its high. For example, if you get out below 56, you can buy again above 58. If you get out below 51, you can buy again above 53. Might get stuck at the 60-minute moving average. May oscillate around it. It's always an important price. A lot of stocks are looking pretty good. I'm going to turn the screen off for a second and do something. Accelerating up, becoming climactic. That tends to attract some profit takers. So we might get a pullback, but we have 6 consecutive bull bars, all, well, 5 of them closing near their highs. So I would not be thinking about shorting. So yeah, you can take profits on longs. So if you bought the close at 62 and you get a bear bar, you can get out. You can try to get out around break even. You can get out below a bear bar 63. But the first reversal down will probably be minor, so I would not short. I want to check one other thing. 1 minute here. I'm checking something. Yeah, we go back here. So reasonable to exit longs below a bear bar 63. This could be like 14 and go straight down, never letting the buy the close bulls out. It's more likely going to be like 35. You get disappointment 36, and the bulls who bought the 35 close or 35 high place a limit order to get out around break even, maybe a point worse than when they entered. And if they do exit, you get that. Remaining bulls giving up 39. Reasonable to get out below 63, but there probably will be buyers either at the 63 low or 5 points lower, 10 points lower, and down at the 2 averages. And for the bears, you got 6 good-looking bull bars, probably a minor reversal. So I would not sell below 63. It could be like 36 if we go sideways and get a micro double top. Then the bears might be able to sell, but I would not be shorting. Probably buyers either at the 63 low or 5 or 10 points lower. When you have a buy climax and a bear bar closing near its low like this, I do not buy the low of the bar. So if I'm looking to buy with a limit order, I'll usually try to get in like 5 points or 10 points below the bear bar, or 5 or 10 points below the close of the bull bar 62, which would be right around here. So I'd rather buy lower. The bulls might get a high one, 64. I gotta go back to check something over here. Reasonable to get out of longs. I don't think you have to. You can wait to see if we get 2 or 3 bear bars. But, we took a long time, 20 bars to get to the 60-minute moving average. We're testing Friday's close, Friday's high. You got to be wondering, are we going to get back down to the 2 averages? Whenever you have the 60-minute moving average and the 5-minute moving average, both reasonably flat and near one another, it's a sign the market is sideways, and it increases the chances that the market will continue sideways. The moving average is still going up here, but if we get 2 or 3 bear bars, the 5-minute moving average will start to go sideways as well. Suppose you do not get out below 63. What do? Well, if you have 2 bear bars and both close near their lows, I would get out below 64. If it's also a bear bar closing below its midpoint. But I still think it's a minor reversal. And I do think limit order bulls will buy, as I said, maybe not at the 63 low, but maybe 5 or 10 points below 63. And we won't necessarily go a lot higher, but we probably will have to go sideways before we can go down, like 36, 37, 38. So there's probably not much downside risk right now. High 1 with 2 bear bars. Also, you have by the close bull 62, disappointed at 63, 64, and they may sell with a limit order around the 62 close. And then you have other traders, bears, who see the buy climax, 60, 61, 62, and 2 bear bars. They think that probably will be sellers either 64 high or 63 high. So they'll have some limit order bears selling the 64 high and or 63 high or 5 points higher. So probably we're going to go more sideways to down here. Most traders are not going to buy above 64 or 63. For the bulls, a high 164 with 2 bear bars and a buy climax. So I think it's not worth buying above 64. Bull bar 65, that's better for the bulls, but I think it's a minor reversal. The bulls buying it are hoping we get a bar like 14 or 60, 61, 62. But you probably have enough disappointed bulls 62 who will try to sell with limit orders around that 62 close, and therefore we're probably not going to go much above 65. For the bears, I did not think it was worth selling below 63. You have 2 bear bars 64. You could sell below that. I would not. And for the bulls, a buy climax, a lot of bulls would like to see 2 small legs sideways to down before looking to buy again. And they would like a better looking buy signal bar 65. So it's not a good stop entry sell, and it's not a good stop entry buy. What that means, there probably are buyers below and sellers above, and we're probably going to go sideways for a few more bars. Always in long, right? And reasonable for bulls to exit below 63, and reasonable for bulls to buy again with a stop order above a bull bar closing near its high, 65, but it's only a very small body. And after the buy climax and the 2 bear bars, I think there's a 50-50 chance we're going to get a couple legs sideways to down. So if you buy above 65, you hope that we accelerate up, but we're probably not going to. Too many bulls will want to give the bears 2 chances to reverse the market. So they'll wait for 2 legs down, which means they'll wait for a second reversal up. Can you buy here 65 and use a wide stop and scale in? You can, but it could be like what we had 38. It could you might need like a 20-point stop because if you bought above 37, it fell almost 20 points. So it's really not very good to buy above 65 and then put a stop 20 points down, somewhere down here. That's risking too much. So if you buy below 65, I would get out. I did not buy below 65, but if I did, I'd get out below 64. And for the bears, are they going to sell 65? No, it's a high one and a strong rally, and it's a bull market. But they might sell with limit orders above 63 and scale in higher. Or they might sell a second reversal down. If 66 or 67 is a bear market, they might sell that. Always in long on a high one buy, 65, but not very good probability, and probably not a lot of profit potential. So that means the reward is probably not very big. So that means the risk reward is not very good. So you have relatively low probability and a relatively bad risk reward for stop entry traders. So that means the opposite's probably true for limit order traders. The probability is probably at 50% for limit order traders, and they probably don't have to risk too much because we probably will not go much above 63. The problem with the limit order traders is they're probably not going to get much reward. So this is not good swing trading right now. It's more scalping and wide stops and scaling in. Bears, I would not sell 65. Bulls, bears might sell 63 and then scale in 5 points higher, 10 points higher. Bulls, if they buy 65, I think it's better to use a wide stop and scale in. And whether you're a bear selling or a bull buying, I think it's probably good to be scalping for 5 or 10 points. You take a trade, you hope it becomes a big swing, but it's probably not going to happen. We probably have exhausted bulls. Big enough bull surprise, 60, 61, 62 to get a second leg sideways or up. 66 could be all that the bulls get, a second leg sideways. 50, that's a second leg up after this. It was a slightly higher high. 38 was a second leg sideways, a slightly lower high after 35. When in doubt, it's usually better not to buy near the high. It's usually better to buy a pullback like a couple legs down through some kind of support, maybe the 2 moving averages. And for bears, recently strong bull trend. I did not sell below 63. I did not sell above 65, so I'm currently flat. Now the bears have a low 2, a second reversal down 66. We'll have 2 doji bars. The bears are hoping it'll be like 38, 39. I think the math is not very good. So I think the best choice is flat, but if not flat, we have the high one by 65, get out below 64. And for the bears, some bears will take the short 66, but that's a pretty strong rally. Those 6 bull bars, that makes the profit potential not very good. So I think it's better to wait for more of a pullback to sell, wait for a better second reversal down. So, for example, a breakout and a second sell. You can see not many stop order bears selling below 66, not many stop order bears selling below 64. The neckline of the micro double top, 62, 66. We had more bears selling below 37, the neckline of the micro double top, 35, 38. We're not getting that here. And that's because that was less clearly bullish than this is. So you have fewer bears willing to sell the stops, even a second reversal down. For the bulls, it's a high 2, 67, but most bulls will want a pretty good bull bar. It does not look like they're going to get it. So it's still probably better to wait. High 2, always in long, but another tight trading range. And looks like we're probably going to have a bear body on 67. Maybe the bulls can get a small bull body. I said reasonable for the buy the close bulls to exit 63. This is a high 2, but it's 4 dojis and a bear body. So that's not going to attract a lot of buyers. Plus, there will be some bulls looking to sell around the 62 close. The bulls have bought 62, disappointed, 63, 64, 65, 66, 67. So getting late in the day, so you will get some bulls selling. Now, will there be more bulls willing to buy, taking a chance we go outside up above yesterday's high? I don't know. It's not good enough for me to take the buy. And for the bears, I said I did not sell the 66 on load 2. Might be some limit order bears 63, 5 points higher, 10 points higher. Well, we're in the final hour. So you have less ability to scale in higher. You can run out of time and have an increasingly big short and end up losing a lot of money. So late in the day, final hour, scaling in, I will do it in special circumstances, but I usually will not. Now, what happens, you can see we're stalling around the 62 close. You got disappointed by the close bull 62. Some bought more, 5 points lower, 10 points lower. But a lot of them, whether or not they scaled in, are trying to get out around the 62 close. And if I'm long in a situation like that, and I'm fairly disappointed, instead of placing the limit order to get out break even, I'll place the limit order to get out with maybe a 1 point loss. And that's why 68 high so far is below 62 close. You have some bulls sufficiently disappointed that they're happy just to get out, even with a 1 point loss. Now, probably sellers above 63 and 5 points above, 10 points above, but we're getting late in the day. So I think the math is not great. Is it still by the close 68? I think the math is not great here. Anybody buying is hoping we go outside up, we go above yesterday's high. They hope we go a lot above it. I don't think we'll go much above it if we go above it. So I do not think there's much profit remaining for the bulls. So you can argue by the close, but I suspect there'll be sellers 63 high, 68 close, and higher scaling in. Stop order bears need a good looking sell signal or 69. Will there be more bears shorting and scaling in and more bulls taking profits, or more bulls buying the close, hoping that we form an outside up day? The context is really good for the bulls on the daily chart. And I think another thing that's good for the bulls is if you read any stock market news or watch any stock market stuff on TV, all you see are bears. Everybody talking about the market falling below 3,300, the market maybe falling to the pandemic low, the market cracking 40%. And I think that's good because it scares out a lot of people. And once the weak bulls are gone, there's no one left to short. The bears do not want to short any stock that's already down 70 or 80%. Now I'll use Kathy Woods' ARK as an example. The bears are happy to short when it's at an all-time high, but now it's down 70%, 80%. Not many bears want to sell down here. So most of this selling is not bears, it's bulls exiting, bulls giving up. That reduces the chances that we're going much lower. That's also consistent with what I've been saying. I think the bottom on the daily chart is not strong, not reliable, not high probability. I don't think we're going to go much below the low if we do go below the low. And there's a potential, I think, for the market to rally for a month or two. Daily chart, higher or low, we could easily go up here over the next few weeks. I'm long a bunch of stock in all kinds of different accounts. I'm not heavily long, but I am long, taking a chance that we go up here. Usually in a bear trend, if I'm buying and the market bounces pretty much, I'll get out. So this is the E-mini daily chart. But if I buy, and I get a big bounce and second leg up, I'll usually try to get out around the top of the first leg up. So I did buy different stocks down here and same over here. So, if you get a disappointment bar, try to get out if it gets back to that close or that high. So typically, if I buy here and I see that and then I see this, I'll get out when the market is around that close over here. If I think the market might get a major reversal, I'm less willing to sell out of longs. I still might take some profits. I usually do. And right now, I do not think the math is good enough for this to be a major reversal. It could turn into a major reversal, but right now it's a pretty tight channel with a lot of selling. So I think it'll be up. Plus, we do not have a good buy signal bar. I talked about that. When you get major reversals, you usually get pretty good buy signal bars. I use the weekly chart as an example. Big sell-off, and then we got a good-looking bull bar. Big sell-off, good bull bar. Big sell-off, good bull bar. Big sell-off, good bull bar, and then double bottom, bull bar closing near its high, bull bar closing near its high. Big sell-off, second leg down, bull bar closing near its high. Couple legs down, bull bar closing near its high, bull bar closing near its high. Big sell-off, bull bar closing near its high. And that's the same is true on the daily chart. If you're going to get a major reversal, it's usually going to begin with a pretty good bull bar. So if you're getting a reversal and you do not have a good-looking buy signal bar, it increases the chances that the reversal is minor. This is the daily chart, not a very good buy setup. And this is the weekly chart. We have a 2-bar reversal, but it's not the same as that or a 1-bar reversal. 1-bar reversal like that, it's more climactic, more dramatic, and more emotional, higher probability that you're going to go higher. Monthly chart, I keep saying the same thing. This is probably a minor reversal. We may get down to here, the pre-pandemic high, but I think only a 40% chance. I think we're probably only a 30% chance. I think whatever low we get will probably hold above this. Another reason to think the market is not going to go down much over the next second half of the year, for example, is the first 6 months. It's one of the biggest sell-offs that we've had in decades, and that reduces the chances that we'll have another really big sell-off in the second 6 months. Bulls, I'd get out. Just a little bit disappointing, 69. I'd get out maybe a couple points below 69. I would get out below a bear bar closing near its low 70. And you have limit order bears 63 high. A lot of them will try to scalp off 5 points. A small pullback bull trend, the pullbacks are small, so it's hard to make much more than 5 points. So the bears have sold 63. A lot of them have limit orders to buy back 5 points lower. So just a little bit below where we are right now. Bulls high 170, but it looks like we're transitioning into either a weaker bull trend or a trading range. So I did not buy above 67, and I'm not going to buy above 70. I ended up not selling 63 high because I wanted to talk. If this was not a chat room day, I probably would have sold the 63 high and then decided on the speed of the fall, whether to get out at 5 points or maybe at the moving average. And since it's not falling very quickly, I probably would be trying to get out around 5 points down from the 63 high. Undoing 68, kind of like 14, 15, 9, 10. Here it's spread over 3 bars instead of 2 bars. More and more bulls are panicking out. The 2 moving averages are near one another. So magnets below. Limit order bears were able to make 5 points, and this bar is becoming big, so they may try to get 10 points. Can you buy the close betting on a bounce? I don't know. I'm not going to. They sold the close of 68, 62, big bull bars, and you got to be wondering, will they buy the close of a big bear bar like 2 and 7? Can you sell down here? I don't think so. It's still always in long. You're far below the high. It's a small pullback bull trend, and this is already a small pullback, and you're right above support, the moving average. So not a lot of profit potential. You can always argue, well, suppose it comes all the way back down to the open of the week. If you're willing to take that chance, then sure, sell the close, but it's a very low probability bet. I want to do something here. This is the spider. Okay. What I want to check something on my other computer to see if I can do it on this computer. No, I cannot. If you ever want to know the probability of something happening, you can look at an options quote panel and look at the delta. And the delta is very close to the probability that the market will reach a certain price by the close of the day that that particular option expires. And we have daily options, and there are options, spider options that expire today. And let's say, what's the probability of the market coming all the way down to 375 on the spider? You simply look at the 375 price and you look at the delta of the positions, and the delta of the puts is 10. That means right now there's a 10% chance we're going to get down to this low by the end of the day. So if you ever want a quick idea of what probabilities are of the market reaching a certain price by the end of the day, you can simply look at the delta. And you'll notice that if you do look at the delta, you're going to find out that the at-the-money put and call both have a delta very close to 50. If the market's going up, the call delta will be a little bit higher than 50, and the put delta will be a little bit lower than 50. But usually the delta of the at-the-money options is always right around 50. And that's true even if the market is selling off really strongly or rallying really strongly. And what that means is, even if the market is rallying really strongly or selling off really strongly, at any given moment, it's pretty balanced between the bulls and the bears. Now, the market is constantly at the current fair price. You can say, well, if it's rallying strongly, how can that be the current fair price? Well, it is. Options traders are willing to sell calls in a rapidly rising market, and equity traders are willing to sell the spider in a rapidly rising market. Computers are willing to sell the E-mini in a rapidly rising market because they know at any given instant the probability of the market going up a certain number of points or down a certain number of points is about the same. You have to decide how long are you going to hold a position. Are you going to get out today? How many points are you looking for? 1 point, 20 points, 100 points. But the important point is that the market is always fairly neutral, even if it's rising rapidly or selling off rapidly. There's always going to be an institution or many institutions willing to take the opposite position. Here we've got a little wedge, 62, 68. The bulls are trying to get above the high of yesterday. They want today to be an outside up day. But tight trading range since 63, even though it's still a bull channel. And you have a big bar, so big risk. You can see 70, I said bulls might buy the close, and they did. But 62, they sold the close. They might sell the close of 71 as well. On the open today, we tried twice to get below last week's low, unable. And therefore, all of these attempts to get above yesterday's high, Friday's high, they're failing as well, and we could get a reversal. You can see we're not racing up 71 close, and that's because you'll have a lot of bears willing to sell the close and take a chance that for the tight trading range 63 is going to continue. So anything bullish, they sell 62 close, 68 close, and 71 close. Anything bearish, they buy 63 low, 64 close, 70 close. Limit order market, tight trading range. So what's a better trade right here? Buy or sell the market? Well, I think it's the tight trading range of 62. So I suspect it's probably better to sell. But the problem the bears have is if they're selling, it's also better to use a wide stop and scale it in. And that's a big problem. We're right at the end of the day, and we have a pretty good magnet above. So rather than sell the market, I think bears would rather sell below a bear bar closing near its low. So if 72 closes near its low, and it's a decent sized bar like 63, I think you'll get bears selling that. This is the end of the hour, bar 72. And we're trying to, that high, Friday's high, it's important. You know, it's yesterday's high, Friday's high, but it's also the neckline of this double bottom. So the bulls would like to get above it. They'd like to get far above it. They'd like to close above it, and that would increase the chances that we get a measured move up to last week's high. This is a 60-minute chart. Here's the 5-minute chart. I was talking about having a whole bunch of accounts, and in some accounts I trade just certain things. In other accounts I trade other things. In some accounts I might not trade, but hold on to dividend paying stocks. Other accounts, I pretty much just trade for real fast money, you know, a bounce for a day or two or three. And if this is the start of a bounce for the next several weeks, you could buy almost anything and make money. You know, I talk about the high quality stocks, the Apples and the Microsofts. They're oversold, higher low, major trend reversal, Apple, Microsoft, Google, and then you have the tech stocks, and the semiconductors. They're much more oversold, but they're probably, if we go up, they're going to go up as well. It's A and B. And then you have the value stocks. Value stock, I talk about this sometimes. There's no such thing as a value stock. Every stock is a value stock. If you want to buy, you think the stock is cheap. So even if you're buying in a really strong bull trend, you're buying because you think it's a good value. You think the market's going higher. So the term value stock is really stupid, because any stock that you're buying because you think it has good value. But they coined the term value stock instead of, because some traders tend to buy stocks that are down a lot. You know, it's better than saying a garbage collector stock. You know, and you know, I do think a lot of Disney, another garbage stock, but it's got good value, and if it bounces, even retraces 50% of that, it's going to be, 30 or 40% gain over where we are. Now here's Disney over the past year from 200 to 100. And even if we bounce to this breakout point, that'll be a 30% profit. And it's probably not going to sell off much more. It's already down 50%. And it's, the stock is a garbage stock, but it's a quality company, so it's probably not going a lot lower. Then you got the PayPals and the Squares. Here's PayPal. Probably not going a lot lower. It was 300, now it's 75. So down 75%. If it just gets back here, all right, that's 120 from 70. That's a 60 or 70% gain. And it's going to get back here. Probably it's going to get back here before it goes much lower. So, and the math is really good on the value stocks, especially if you can use wide stops and scale in. I sometimes use the example of Freeport-McMoRan. I'll put up a weekly chart. Back over here, where is that? $10. Carl Icahn. Carl Icahn is a billionaire investor. Announced that he was buying Freeport-McMoRan. What's the chance of it going to 0 before it gets to 20? Maybe 10%. So it's a really good buy. And if it falls down more, like $5, it's an even better buy. What's the chance? And when it's at $5, what's the chance it'll go to 0 before it gets to $10? Probably 10%. And probably will get up here before going to 0. So he bought 9 times a value stock, a garbage stock. It sold off from 60 to 5. Right, so it lost 90% of its value. And he scaled in 9 times over the course of 6 months or so. And, value stock, in other words, a crummy company. And here, it's up to 20. So if he bought at 10, he did. If he bought at 5, he did. If he bought in between, he probably doubled or tripled his money. And if he held, I don't know if he did hold, it came back down and tested the low. But if he did hold, his $5 went up to 50. All right, so 1,000% gain. Obviously, it's selling off big right now. But the point is, value stocks, you always hear in bear markets buy value stocks. It's because, if they retrace 50% of the bear market, which is common, it'll be a gain of more than 100% in your stock. So that's why you always hear about people say in bear markets, look to buy value stocks. And I do tend to buy value stocks. Lately I've been buying them. And different ways to do it. You can buy the actual stocks like Disney or PayPal or NVIDIA, or you can buy the QQQs. That's the NASDAQ ETF, or you can buy ARKF. That's Kathy Woods' basket of garbage stocks. And I tend to trade that. A lot of times I'll day trade it as well. Here's a 5-minute chart. And that's not the one we want to mark out. Okay. This one. Okay. Look at that little doji bar right here. You say, well, there's nobody trading it. Well, that's 160,000 shares traded on that little doji bar. So there's tremendous volume trading in this ETF. And I usually just enter and exit at the market. Sometimes I'll exit with a limit order profit target. Sometimes I'll buy with a limit order below the market. But a lot of times, if it's going up, I'll just hit buy, buy the market. And huge range, a 10% range from 40 to 44. And that, I don't know how many stocks she has in it, probably 20 or 30. And it's all the garbage stocks. It has Tesla, but beyond Tesla, it's mostly garbage stocks. but it's probably not going to zero. And it looks like to me a base looks like a double bottom pullback. And at a minimum, I would look for a measured move off. So you buy here at 40, goes to 60, that's a 50% gain. And you say, well, that's a big gain. But look at, okay, it's really nothing. You know, when you look at the chart, if it gets up here, no one's going to say, wow, what a monster rally. You know, it's a small rally based upon the past year. But in terms of percentages, you know, it's a huge profit for people who bought down here. And I am long. I think my entry is around 40. And I'll buy more lower if it goes lower. I bought it over here and I ended up exiting, taking profits up here. Bears keep trying to get wedges. Whenever the market is in a tight bull channel, it's always forming wedges, lots and lots of wedges. And most of them, minor reversals, they become high one or high two bull flags and the market keeps going higher. We transitioned into a trading range 63. So I don't think we're going much higher. So I think, you know, we may get down to the 67 low by the end of the day. But, you know, I'm not going to sell below 73. If 74 closes on its low, you know, you'll probably get some traders selling a wedge, 1, 2, 3, a trading range. Maybe we'll get down here, moving average. But, you know, I don't think there's a lot of profit potential. You know, I don't think there's a reasonable chance of a swing down. So that makes the math bad. If you're looking to sell below 74 and you're trying to make 5 points, you're risking, what, 7 points, 8 points to make 5 points? You have to be right 70% of the time for it to be simply a break-even trade. You have to be right 80 or 90% of the time for it to make sense mathematically, to make a good trade. And is it an 80% chance that we're going to fall 5 points below 74? It's probably not 80%. It might be 60%, but not 80%. So you can win 60% of the time and lose money because your risk is greater than your reward. Some of the traders selling here are hoping for a collapse. They're looking for like 1 and 2 or 15. But they know we're probably not getting it. It looks like the market got exhausted 62 and entered a trading range 63. Can you buy the 73 low, a small pullback bull trend? I would not. I'd get out of longs below a bear bar closing below its midpoint, maybe 74. I'd get out of longs a couple points below any bar, 73. And outside down, can the bulls buy above 73? Betting we'll get outside up day above yesterday's high. We were very close to yesterday's high. I did not think we were going to get above it. But, you know, the bulls have maybe a 50% chance of doing that right now. Because of the transition into a trading range 63, the math is less good for stop order traders. Most traders should wait for tomorrow. Not quite 00, the low of 73 above the low of 72, but still a small pullback bull trend. Does it make much difference if today becomes an outside up day? I don't think it really makes much of a difference at all. By the way, I talked about this earlier. No, I'll do it. No, I'll do it over here. You can see this little red dash. That's yesterday. And I said, trade station will remove that usually by the end of the day. I'm going to reload the data and let's see if this dash disappears. They usually keep the holiday in for at least a couple hours, and then later in the day or after the close, they'll remove it, and then these two bars will be adjacent. I'm going to reload the data right now and see if that little dash from yesterday goes away. Yep, you see it went away. The two bars are adjacent to one another now, whereas a minute ago there was a dash, a little bar like this in between the two. And I've never understood why they do not remove the bad day before the market opens. I don't know why they wait hours before removing it. Bulls, I'd get out below 74, did not close below its midpoint, but it's a reasonably big bear body. And it's still a small pull by full trend. And we have a magnet above. However, we're probably not going to go much above that magnet if we go above it. So it's not a good stop order buy above 74. Next targets, all of these lines. 60-minute chart. I'll move these things over more. I'm going to move that down here because open of the month is today. Actually, that's not true. I'll fix that. Here's July 1st. So that's the open of the month. '74, even though it's a new high, it pulled back. So I would consider the 74 high a high one buy signal bar, but it's a bear bar, and now possible wedge 68, 73, and probably not much more up. I am flat right now. Once we had that 62 breakout, I decided to go flat, and I did not buy 65, did not buy 67. I debated selling 63 with a limit order for 5 points. I did not do it. So I suspect I'm not going to take any more trades. One of my general rules is if the market is in a tight trading range, at least 4 bars at 12.45, I usually do not take any more trades. Sometimes that's bar 75, the current bar. Sometimes if the bar is a good signal bar and the context is good, I will take a stop entry trade. But we're in a strong bull trend. We have yesterday's high, magnet above. We have a bull bar, but it's only a doji. So I'm going to let it go. Also, one other point. If you buy above 75, where's your stop? Is it below 75? No, it's below 74. Whenever you have a very small buy signal bar, if you put your stop below it, your risk is small. So if your risk is small relative to reward, your risk reward is great. Whenever your risk reward is great, your probability is bad. So whenever you have a tight stop, the probability of making money is low. So a tight stop usually is going to get hit. A wide stop, the wider the stop, the higher the probability you'll make money. The S&P is right now at 3,800. Let's say you put a stop at 1, in other words, 3,700 points below where we are. Right? The stop is never going to get hit, and you're probably going to make money. But you might have to wait a long time before you make your money. For example, let's say we sold off from here 1,000 points down. You might have to wait a couple of years before you make money. But when you use a wide stop that is super wide, you're almost always going to make money. And if you use a wide stop, if you use a stop that is very, very small, chances are you're going to lose money. You won't lose much, but you'll lose often. And all those little losses can add up to a big loss. You can see the bulls who bought with a stop above 74. They're thinking right now, darn, I knew the stop was too tight. So they're afraid of getting stopped out. Usually a tight stop is going to get hit because not enough traders will take the buy. You can see it hit the 75 low, but did not go below. And that means a lot of the bulls have bought 75, placed limit orders to buy more at the 75 low, trying to prevent the market from dipping below 75 and hitting their stops. Sometimes the market will get very close to yesterday's high or yesterday's low and then reverse violently. We reversed up from above last week's low on the open, but sometimes it'll rally all day, get very close to yesterday's high. Instead of going above yesterday's high, it sells off dramatically. Got right to below yesterday's high and sold off. It can happen any time of the day, here or at the end of the day. Got very rallied strongly, like today, sold off on the open, like today. Could not get above yesterday's high, and then collapsed into the close. Big rally, could not get above yesterday's high, and sold off in the final few bars. Here, sold off a little bit, unable to get above yesterday's high. Can you sell the market betting that it's not going to go outside up? Well, there are computers doing that. But right now, it looks like we probably are going to go above yesterday's high. I would get out of longs below a bear bar, 77. I would get out of longs one tick below 75. The bulls are trying to demonstrate that they are resuming the rally from a couple of weeks ago. And therefore, they're trying to achieve as many goals as possible. The more bullish things they do, the more traders will trust the market's going higher, and the more traders will be willing to buy. You can see we got really close to yesterday's high, but unable to break above it. I just checked, and we hit yesterday's high exactly to the tick. So today is a variation of an outside up day. We went below yesterday's low, and we reached yesterday's high. The bulls are still trying to get today to close above yesterday's high. Bulls trying to get above yesterday's high. It looks like they probably will. But nothing to do right now. I would not buy above 77, and I would not sell below 77. Okay, outside up day. Reversed up from below yesterday's low to above yesterday's high. That's a bullish thing. If we close above yesterday's high, that would be more bullish. If we close far above yesterday's high, that would be more bullish. But this is already bullish. Overall, I think a good day for the bulls. Basically sideways for half the day, and then we rallied. You can say the rally began at bar 8, but it was still basically sideways until the middle of the day, 41, and then a small pullback bull trend. On the open, we had a pair of bear bars closing on their lows or near their lows, so it's sell to close. But we're right at yesterday's low, and we're far below the average price. So if you take it, you're looking for a swing. I suspect we're not going to go down much. Also, we're still around a 50% correction on the daily chart. And we had the biggest 6-month drop, or the biggest half of the year, biggest bear market in the first half of the year in a long, long time, decades. So it reduces the chances the second half will also be big. And then, as I've said many times, even though we've sold off for 6 months, now 7 months, I still think on the monthly chart it's a minor reversal. And then we'll lead to a trading range maybe lasting a year or two. So it's sell to close on the close of 2, but you're far below the average price, so you've got to make quick decisions. Reasonable to get out 5 points above any bar, bar 3. With those 2 big bear bars, probably bears will sell the 3 high. It's a bad buy signal mark. sell more 5 to 10 points higher to put a stop above 1. So not great to be short at the close of 2. If you don't want to risk 2 above 1, you can get out 5 points above 3. Then we have a bull outside up bar, but closed above the high of 3. So it looks like we may go sideways rather than up. A bear, IOI, bear inside bar after an outside bar. It's a low one. We had a new low 4, and then an inside bar 5, with a tail and a 4-bar type trading range, and a sell climax. So, and we're far below the moving average. With 2 bars that are not bearish, 3 and 4. So that will reduce the number of traders selling down here. So you can sell, but you have to make quick decisions because it might reverse abruptly. 6, a high 2, a second reversal up from below yesterday's low. Possible low of the day, but only 1 bull bar. And this is a bear doji after bear bar 5. So I'd rather not buy above 6. Bears, they can get out above 6, a high 2. They can get out 5 points above a bear bar. Outside down 7, so third push down. Possible wedge. Down 2, down 6, and then up on 7 and down on 8. So it's a possible wedge. Outside down, but closed with a big tail below. It's not strong enough for me to sell this far below the average price. 4 sideways bars here, dojis here, big tails. It's not above average bearishness. I don't want to sell this far below the average price. It looks like a trading range open. Bulls 8, a reasonably good bull bar, possible low of the day, but a tight bear channel. So even though it's a wedge, it's probably a minor reversal. Maybe we'll get to the moving average and the 1 high, but a reasonable buy. 8, 9, very good follow through bar. Probably always in long, but we might have a double top 4, and therefore there may be a lot of bears selling the close of 9 that ain't a double top. I would not. We have a wedge, so typically we'll get 2 legs sideways to up, and this is only 1 leg. So bulls will buy the first reversal down. For the bears, double top 4 and 10, but a tail, and probably we'll get a second leg sideways to up. If 9 was at the moving average, I'd be more willing to sell the close of a big bull bar, but it's not, so probably buyer's below. We have an II. For the bears, double top 4. We're still far below the moving average, pretty far below, and this is a trading range. Now we have 3 or 4 bull bars. So I'm not willing to sell below 11. It's not bearish enough. And for the bulls, you can buy above 11, but I think 10 is disappointing, and the tail on the top of 11 is disappointing. So if you buy above 11, I think you have to get out quickly if it does not go up strongly. 5 bar tight trading range, 13. Can you buy above 13? Can you buy above 9? We have a double top 4 and 9. Never really triggered. We never went below a decent bear bar 10, but it's a double top. So bears might give up above 9 or above 4. Big bull bar closing near its high, closing at the open of the day, open of the week at the moving average. Bulls hope that it's the start of a bull trend. Is it buy the close? It might be sell the close. I think this is 50-50. Higher probability, wait for a breakout above the moving average, because there will be bears reflexively selling the close, the close of any big bull bar closing near the moving average when we are below the moving average. I think it's a bull surprise. We should get a second leg up, so I'm not going to take this out. 15, really good bear bar closing near its low. I failed breakout above the double top. Possible, let me catch my voice. Possible high of the day, lower high double top. We have the 2 legs up, 9, 14. I think if you're still long, if you did not get out with 10 points at around the moving average, I would get out below 15. And for the bears, they're hoping we break below the neckline at 8 and fall for a measured move down, 30 points down. I think we're in a trading range open. And selling below 15 and selling it in the middle of the range. I think you can do it, but your stop is above 15, above 14, and you really need it to drop pretty quickly. If it does not, then the trading range will probably continue. Okay, we got a 16 doji bar. The bulls want a double bottom 12. 15, enough of a surprise. We'll probably get a couple legs down, so I'm not going to buy a doji bar 16. But if I'm a bear, I'm concerned that we did not collapse. So bears will start playing back shorts. Bear bar 17, possible small pullback bear trend, but I think it looks like a lot of sideways bars here, and then here, and then here, in the middle of what is still trading range open. If you're selling, it's better to sell high, not in the lower half. Bears trying to get a breakout, but now we get 3 legs down, 15, 17, and 19. If we reverse up, it'll be a wedge, and it'll be a double bottom. And that's a common type of reversal in the trading range open. 21, a bear bar. So yeah, it's a wedge, and it's a double bottom, higher low double bottom. Might get a triangle. We have a lower high double top 14, so this could rally to a lower high, but it's not a very good looking buy setup. The wedge is good, the double bottom is good, but the signal bar is bad. The bear is a low one, 22, but a bull bar, probably buyers below, limit order bulls will buy below. And then a high 2, 24, 21, but only a doji, not very good. And then a bear bar 26, not a very good bar. You got a double top 22, 25, on the double bottom 20 and 26. You got a tight trading range, breakout mode, and it's within a trading range, breakout mode. If we do start to go up above 25 in the moving average, bulls will buy. If we start to go down below 20 and 8, bears will sell. But not a good stop entry setup, tight trading range. Bull surprise 27, unlike 14, closed far above the moving average. And so an increased chance will go higher. The bears will try to get a lower high in a triangle, and the bulls are hoping this is the start of a bull trend day. Bull follow through 28, fairly big tail, so that hurts the bulls a little bit. But now we have consecutive bull bars, one big closing near its high. It's by the close, 2 closes above the moving average, always in long, probably buyers below 28. Maybe we'll test the 25 high. 30, a bear bar closing near its low, like double top 28. And now we have a triangle. Lower high 14, lower high 30, higher low 20. Couple legs up, 25, 29. Possible high today. Okay, short, but I think we'll probably get the big buyers around the moving average in the 25 high, so I'm not willing to short yet. Maybe if we get 2 or 3 bear bars, I'll sell below. And then 32, a high 1, bull bar closing near its high. Test of the moving average, maybe a test of the 25 high. It's a tight trading range, that lowers the probability. And we still have a lower high 14, so it still could be a triangle. And it might be a wedge, 3 legs up, 22 or 25, and then 29, maybe 33. 33, a bear doji, a triangle, a lower high. A lower high double top 14, a wedge with 25, 29, but a doji. So I'm not willing to take the short. Probably buyers below. High 1, 34, a doji, 7-bar bull microchannel, 7-bar tight trading range, but a small pullback bull trend. And we're still on the buy above 27, above 29, and above 32. You can buy, but I would only buy for a swing. Next target is the 60-minute moving average and possibly yesterday's high, but I think it's probably too far up to get there. We'll have to accelerate up, which we did. 36, disappointing follow through, possible wedge, 22, 30, failed breakout, high of the day, but small pullback bull trend. You could short it. I'm not going to. It looks like a small pullback bull trend, so I'd rather buy a high 1 if we get a bull bar closing near its high, maybe 37 or 38. 38, a bull bar for the doji, So not a very good buy. And for the bears, it's a second reversal down from above the high of the day. So it's a low 2, but it's a bull bar and a small pullback bull trend. You could take the sell below 38 or below 37, the neckline of the micro double top. But I'd rather wait to see better looking bear bars before shorting. A pair of bear bars, a close below the moving average, but still a higher low 32. So I'm not willing to sell the close. You can take a chance that we're going to go down. But I want to see things more bearish. A high 1, a higher low 41, but 2 bear bars and a doji, not a good buy. Bull bar closing near its high 43, breakout above the moving average, but it looks like a trading range since 28, and this is pretty high up. And you can buy above 43. I would rather wait for a second bull bar. 45 closing on its high, so that's good for the bulls. The bears are hoping for a wedge with 14.36. So then 46, a bull bar closing near its high, probably by the close. We should get at least to the 60-minute moving average. I don't think we'll get to yesterday's high, but we might. 47, a wedge, 14.36, but a tight channel. I'm not willing to sell below a doji, 2 dojis. I'm not willing to sell below that. It's a high 1, but it's 2 bear dojis right below the 60-minute moving average and a possible wedge. Wedge 36.47 or wedge 14.36. So not a good stop entry sell, not a good stop entry buy. Outside of 49, small pullback bull trend. We should get to the 60-minute moving average. So you can buy, but I would buy with the intention of swinging. And I would get out quickly if it is. 51, a bear bar closing near its low. And nested wedge. Wedge 43.46, bigger wedge 14.35. We'll probably try to get a couple legs sideways to down here. It's a tight bull channel, 43, probably a minor reversal, maybe to the 36 high, but it's a possible high of the day, so it's okay to sell it and then see what you get. 52, a bear bar or a big tail below, so that means the bears have sold scalped for 5 points, and that's not good for the bears. 53, a bull bar closing near its high. The bears who did not exit during 52 should exit above a bull bar closing near its high. Bulls will buy again if they exited below 51. It's still an always in market, so the bulls want to stay always in. If there's a bull bar closing near its high, they'll buy above 53. Double bottom bull buy 49. Breakout 55, but again a possible wedge 36.51. Possible sell to close, but it's a small pullback bull trend. So I'd rather sell below a good-looking bear bar, preferably sideways. 56, wedge 36.51, and a bear bar closing near its low. You can get out below the low of the bar and hope that we collapse. We probably will not. We're in a small pullback bull trend. II-57 breakout mode. Theoretically, it's a sell below the II-57. I would not sell it. It's a bull bar, small pullback bull trend, even though it's at the 60-minute moving average. I would wait to see if we get 1 or 2 bear bars, 58, 59. Instead, we got 58 and outside up bar. It's still long if you get out below 56 or 57. And you're trading always in, you buy again above 58. And now, bigger body 60, tail with bigger body 61. So it's by the close, and the character of the day is changing. It's becoming considerably more bullish. So by the close. Bigger bar 62, 6 consecutive bull bars. So we'll probably get some profit takers, but no one's going to sell the first reversal down. Bulls will buy the first reversal down, minor reversal, probably buyers below 63. You can get out of longest below 63 and wait for a bull bar. 65, it's a high 1, but after a buy climax, you typically should expect a couple legs sideways to down. So if you buy above 63, you probably have to use a wide stop. I think better to wait and for a second buy. For the bears, it's the buy climax and a second reversal down 66, but two dojis, tail 64, probably a minor reversal down to the two moving averages. So I'm not going to sell below 66. High 267, or a bear bar. So not great. Might be a tight trading range starting 63. If you buy above 67, you hope that we get a strong breakout and follow through. We got a good breakout, 68, but this might be a tight trading range. 4 dojis and a buy climax. So there probably are bears selling 67 high, 63 high, and scaling in higher. And bulls after 5 doji or 5 bear bars or dojis, they may start to sell, take profits on big bull bars, 68. 69, second leg up, 62, but a bull doji after a big bull bar. So I'm not willing to sell it. And 70, if the bears get 2 or 3 bars like that, it will become sell to close. But we're still in a bull channel, and this could be a higher low. So there may be as many bulls buying the close of 70 as bears selling. I'm not going to sell. Big bull bar 71, the bears got trapped, but it looks like a possible wedge, 62, 68, in the top of a trading range. So not very good math. You got big bar, big risk, and lower probability. Maybe we'll get to yesterday's high, but probably not much more. And we had an IOI 75, and we got a little bit above yesterday's high, and then we saw stop entry traders today. You can sell below 1 or 2, but you got to be quick to make decisions. Buy above 8, probably a minor reversal. II 11, you can buy above 11. 15, double top, failed breakout above the double top, 4 and 9 at the moving average. You could sell below 15, but I think it's a trading range open. You can sell below 17, bear bar closing near its low. And then not good stop entry buying here. You can buy above 27 or wait and buy the close of 28, buy above 29, buy above 32, above 34. I did out of longs below 36, and I did not short here. Not a good buy, 41, 42, 43. Maybe you start buying 45 or 46, 48, 49 or 50. I'd get out of longs 51, and then either buy above 53. We'll probably get a couple legs sideways to down. 54 was the second leg sideways to down. Still not a very good looking buy. 57, I would not sell because the channel is so tight. You could buy above 57 or above 58, 59, 60, 61. 62 is the biggest bull bar that we've had in well over an hour. It's going to attract some profit takers. So yeah, you could buy above 62, but I'd get on below 63. In the bears, I would not sell 63. I would not. There are no more stop entry sells, and the stop order buys are not very good. 65, 67, 68, 69, 71. So this is not good stop entry trading. Limit orders, obviously the 3 high, there should be sellers above, and probably the 11 low, buyers below. Probably buyers below 22. Probably buyers below 33. Probably buyers below 47. Probably buyers below 57. I thought the first reversal down 63 would be minor, but I don't want to buy below bear bar closing near its low. Probably sellers above 65, but it's a tight bull channel. I don't want to sell. Possibly buyers below 69, but late in the day, I don't want to do anything. And probably sellers above things, above 63, above prior highs, 69, 74, but late in the day for that. Overall, good day for the bulls. It's similar to Friday, a bull channel. Usually you get a bear breakout, but the context is good for the bulls. The bulls on the daily chart are trying to resume the bull trend. So one of these days we may gap up and start to rally. And if we start to get 2 or 3 more big bull days, then we'll probably get up here over the next couple of weeks. I have to adjust the question box. You do not see it, but it covers most of my chart. And I'm working on a 13-inch monitor. so it's difficult to grab the edges of the window. Okay, question, what are some high probability scalp setups that you generally look for? For example, you say 60 to 80% probability. Question, I'm risking 15 ticks to make 10 ticks. Is this reasonable, or is 12.5 ticks profit a better trader's equation? Now, first of all, most traders should be swing trading. And you can always scalp the swing trades, especially early on, looking for minor reversals. So, for example, 8 was probably a minor reversal, but it could get a couple legs, so you could buy above 8. And early in the day, when the bars are big, if I'm scalping, I'm trying to scalp for 10 points. And later in the day, when the bars get smaller and the moves up and down get smaller, I switch to scalping for 5 points. But 8, you could do a swing trade, scalp off part at 10 points. Then you get obvious limit order trades, selling the close of 14. But most traders should be looking for stop entries, whether they're scalping or swing trading. And in general, my general rule of thumb with a scalp is I have to risk about twice what I plan to make. So if I'm planning to make 5 points, I usually have to risk 10, sometimes more. But I'm also usually willing to scale in and use wide stops, and that can increase my probability. The scalping is not as simple as it seems. It's not simply buying the 8 high, placing a limit order to exit 10 points above, and putting a stop below 8. What happens if it goes a couple ticks above 8 and then below 8? Do you exit below 8, or do you buy more? And then do you buy more 10 points below that? I tend to do that kind of a thing. And the more you're able to do it, the higher your probability. But in general, as a general rule, if you're scalping, you're going to have to risk about twice what you're hoping to make. So if you're trying to make 5 points, you'll probably have to risk 10 points. And again, I would focus on swing trades. Most swing trades turn into scalps. Most swing trades, the market does not do what you expected, but it does enough to make a profit. So buying above 8 and then holding for a second leg up 14, and it stops at the moving average, you can get out at the close of 14, or as 15 is starting to turn down or below 15. Or selling below 60, selling below 51, disappointed 52, get out above the bull bar 53. So, but if you're selling in a reasonably tight bull channel, you have to be thinking about scalping part or all. So if you sell below 51, the reversal is probably minor, so it's probably better to scalp for 5 points. Question you mentioned earlier, market has to test back to the 25 high breakout point. What is the rationale behind testing breakout points? Under what circumstances one should sit through breakout tests and exit early and re-enter after the test? And if you're looking for a breakout test, like here, maybe testing 25 high, and you get a bear bar closing near its low 30. It's usually, for me, I typically get out below the bear bar 30 and then wait for the market to get down to around the 25 high and then reverse up and buy again, like about 32 or 34. And the reason why the market tests breakout points is the same reason why it's always forming double tops, double bottoms, wedge tops, and wedge bottoms. The market, traders like to see the market do something twice before they have confidence that the move is going to be good. So very often you'll get a breakout. So the bulls bought the breakout, they bought above 25, and then you get disappointing follow through 28, 29, 30. A lot of the bulls expect it'll test the original price, one tick above 25 or the 25 high, or maybe even a little bit below. And they'll either place limit orders to buy around that 25 high, or they'll wait for the test and then wait for a bull bar and buy above that. Traders like to see the market do something twice before they have confidence that the move is going to go far. That's why you get double tops and double bottoms. And wedge tops and wedge bottoms are also tests, tests of trend lines. I don't have time to go through that now. I talk about it in the encyclopedia. But anyway, that's what it is. It increases the probability. If the market tests a price where bulls bought, so they obviously bought above 25, you can tell that by looking at 27. If it comes down to that price or near that price, will they buy it again? And they did. It didn't get very close to it, but they did buy it again. And the opposite is true. They also test signal bars. As an example of that. We get them almost every day. Put that over here. Of course. As an example of that. We get them almost every day. Put that over here. Here we have a double top high of the day, and we rallied near the signal bar. Entry price sold off, and we tested the high, sold off. Sometimes you'll get almost the exact tests of signal bars. This is kind of one pretty good sell-off. We rallied to just below the signal bar low, and pulled back again. I thought it was a pretty good one sometime in the past couple of weeks. Here, we rallied strongly but could not get above that high. This is a test of that high. Here, we rallied strongly but could not get above that high. This is a test of that high. I probably scrolled past the one I was looking for. Yeah, I'm not finding it. I'm sure I've already passed it. But sometimes the market will test the high of a buy signal bar or the low of a sell signal bar. Like this, it became clearly bearish below that bar, and we tested to very close to the low of that bar over here. Question: what do you think? What do you think is next for crude oil after today's big move and the 20% drop over the past few weeks? You know, they had those idiots on TV saying crude oil is going to go to $160 or $200. You know, you just get idiots all the time. You know, they're on television. They have to say things that will make people watch, so they say dramatic, stupid things, low probability things. And the reason why crude oil sold off is this, a blow off top, an exhaustion move. And over here on TV, they were talking about, I've heard many people say, oh, we're going to go up to 160. This is just a pullback, not a reversal. And my thought was, it looks like a reversal, pretty good reversal to me. We've got a triangle. We broke above it. We're testing the apex of the triangle, which is common. The bulls are hoping that now that we're back at the apex of the triangle, we'll go back up. But to me, the bulls failed to break above this high, and they gave up. And the bears shorted near that high, getting it on double. So trading range since back in March. And I don't think we're going to go a lot higher. I know you get the clowns on TV saying we're going a lot higher, but I think they're idiots. Now, here's the monthly chart. Look to the left. What happened at this price? 100. Over here, well, we were sideways around 100 for 5 years. And what are we trying to do here? We're trying to go sideways again. I don't think we'll go sideways for 5 years, but you don't have to be a genius to look at this and say, hey, we got up to that $100 area where we stalled for 5 years, maybe that tail and bear bar here, maybe we're going to start to stall again. So I think that's what is going on. You know, the market thought this was a fair price around 100 for 5 years, and traders are concerned that it might be a fair price again. In other words, it may not go a lot higher, and it will enter a trading range. And if it's going to enter a trading range, anytime it goes up, they buy. Anytime it goes down, anytime it goes up, they sell. And anytime it goes down, they'll buy. We'll probably get down here below. Here's the triangle right here. We tested it here. Might test it again here. Usually you'll get down to the bottom of the trading range. So I think we'll probably get down to 90. But trading range should last a lot longer. So whenever you think the market might be in a trading range, it's better to only sell high and take quick profits in the middle or bottom, and buy low and take quick profits in the middle or top. So to me, it looks like crude oil's in the trading range since this extreme buy climax. This is similar to what we had in bonds a long time ago. And I talked about it a lot. Here's the monthly chart of bonds over here. I said it was a blow off top, and we should get down to this buy climax low and then that buy climax low, and then go sideways for several years, and maybe fall on the right shoulder, head and shoulders top, left shoulder, head, and then for the next several years drift up and form the right shoulder, and then ultimately, 5 or 10 years from now, we'll be down here, and interest rates will be 6%, 8%. All right. Hope everybody has a good night. Oh, by the way, they release the FOMC minutes tomorrow at 11 o'clock. So it'll be just like an FOMC announcement. Better to get flat ahead of the minutes and then wait at least 10 minutes before buying or selling, and be open to anything, a big bull move, a big bear move, a trading range, a reversal. Okay? Have a good night.